look at the chart for NuScale Power Core, ticker symbol SMR. It is just absolutely plummeted.
Oh, yeah, a total free fall.
Right. I mean, from a high of over $57 down to just $11.67.
It's insane.
So the question you have to be asking yourself right now is, are we looking at a classic falling knife and like a massive retail value trap? Or is this the ultimate undervalued buy-in opportunity for the future of AI energy?
I mean, that is the multi-billion-dollar tension right there, isn't it? The divergence between the incredible narrative of this company and the stark reality of their actual numbers is just staggering.
Which is exactly why we are diving into this today. It is Wednesday, April 22, 2026, and the mission of this deep dive is to, really tear apart a massive stack of fresh market data, technical charts, analyst ratings, and SEC filings.
The whole 9 yards.
Exactly. We are looking past the hype and the headlines to figure out the absolute truth about SMR today. And real quick, please remember to like the video, subscribe to our YouTube channel, and definitely leave your feedback in the comments. It really helps out the algorithm.
It does. And crucially, we need to state right off the bat that this is an educational deep dive for you, the listener.
Right.
What we are doing here is just having a natural human debate about the numbers and the market psychology. This is absolutely not financial advice.
Never.
We're just synthesizing the data, but you have to make your own calls.
Always. We're just looking at the exact same puzzle you are. So let's look at the foundational numbers, because before you can understand why a stock chart is having an absolute meltdown, you really have to look at the actual cash flowing in and out of the business itself.
Oh, 100%. The fundamentals always dictate the underlying gravity of an asset.
Yeah.
Like, you can outrun gravity for a while on pure hype, but it always catches up. Always.
And the gravity dragging NuScale right now is incredibly heavy. So yesterday, April 21st, the stock closed at $11.67, following a brutal daily decline of negative 8.76%.
A bloodbath.
And if you zoom out to the 52-week range, it is honestly vertigo-inducing. We are talking about a peak of $57.42 back in October 2025, crashing all the way down to a low of $8.85 just, over a week ago, on April 13th.
Yeah. It's a breathtaking collapse in valuation. You're looking at a company that is currently sitting at a market cap of roughly $4.004 billion, which, keep in mind, is a tiny fraction of what it was at its height.
Right, but hold on. Okay, let's unpack this. Because a $4 billion valuation implies a massive functioning enterprise. But when you crack open their fiscal year 2025 financials, the numbers do not look like a $4 billion company.
No, they really don't.
Annual revenue actually dropped last year. It fell 14.9% down to just $31.5 million.
Right.
Meanwhile, the net loss is a painful negative $365.8 million.
Whoa.
That leaves us with a diluted earnings per share of negative $2.17.
Yeah, that's rough.
So, I mean, I have to ask, looking at this balance sheet is like watching a trust fund kid with a massive inheritance but a terrible spending problem. How does a company worth billions only generate $31 million in revenue while losing over $350 million?
Well, if we connect this to the bigger picture, you have to look at the mechanism of what they are actually trying to build. NuScale is trying to commercialize small modular reactors, SMRs.
Right.
Traditionally, building a nuclear power plant is like building a bespoke, custom mega project on site. It takes a decade and $20 billion.
Massive infrastructure.
Exactly. NuScale's goal is to turn nuclear reactors into products that are just assembled in a factory and shipped on a truck. It's like moving from the era of massive room-sized mainframe computers to personal, standardized PCs.
Okay, that makes sense. Transitioning an entire global industry from custom mega projects to factory-built products is going to require immense upfront capital.
Immense. This is arguably one of the most capital-intensive, regulatory-heavy endeavors on the planet. Which brings us to the balance sheet. They have total assets of $1.41 billion against liabilities of just around $298.96 million.
Okay, so that's actually pretty good.
It is. Their total liquidity, the actual cash and investments sitting in the bank, is a massive $1.3 billion.
But here's the catch, right? And this is where I think investors are panicking. That $1.3 billion is sitting next to a cash flow from operations burn rate of negative $459.6 million.
Right.
They are incinerating nearly $500 million a year. So that $1.3 billion in the bank isn't a war chest. It's a countdown clock.
That is a perfect way to look at it. The market is doing the math right now. When you divide that 1.3 billion in cash by a 459 million burn rate, that multi-year cash runway suddenly looks like it might only last 2.5 to 3 years.
Oh, wow.
Yeah,
Huh.
that is why that shrinking top-line revenue dropping 14.9% is so terrifying to institutional investors. You really have to consider what happens if revenue doesn't catch up to the spending.
Right, because if you are burning $500 million a year in R&D and engineering and regulatory compliance, you absolutely need to show the market that your commercial revenue is scaling up to eventually meet those costs.
Exactly.
If revenue is shrinking while the burn rate stays high, you are essentially building a bridge where you are running out of materials before you reach the other side.
And if they run out of cash before they cross that bridge, they only have two options, really. They either take on massive high-interest debt or they issue more stock to raise capital.
Which just dilutes the shares of everyone currently holding the bag.
Exactly.
Well, if the fundamental cash burn is so severe, it's directly reflected in the market's technical sentiment, right? That leads us to ask how traders are actually treating SMR day-to-day right now. Let's look at the charts.
Yeah, the technicals right now paint a picture of an asset really struggling to find a floor. The trend direction across the board is neutral to sideways, but leaning heavily bearish.
Heavily. I mean, if we look at the moving averages, SMR is trading way below its 200-day simple moving average, which sits way up at $26.87. That is a glaring sell signal.
Absolutely.
But it is clinging just slightly above its 50-day SMA of $12.27. Walk us through what those two lines actually mean for the psychology of a trader right now.
Sure. So think of the 200-day moving average as the long-term tide of the ocean, and the 50-day moving average as the immediate waves.
Okay.
When a stock falls radically below its 200-day average, going from $26 down to $11, it signals to institutional investors that the macro trend is broken. The big money has stepped back.
Right.
Now it's hovering right around that 50-day line of $12.27. It's trapped.
And the momentum indicators, like the MCD, are super mixed. But the 14-day relative strength index, the RSI, is currently hovering around 32.6 to 42.7.
Yep.
So it's approaching what is traditionally called oversold territory, but it's still signaling neutral or sell. And here's where I want to push back on the common narrative.
Okay, let's hear it.
Retail traders look at this chart. They see an RSI approaching oversold. They see a stock that is down nearly 80% from its highs, and they instantly think, oh, discount, I have to buy the dip. Why is that often a trap for retail investors?
Because retail investors often misunderstand the mechanics of the RSI indicator. A lot of people think of the RSI like a rubber band. They assume that if it gets stretched down into the 30s, it physically has to snap back up.
Right.
But in a bearish trend, RSI is not a rubber band, it's a speedometer.
Oh, that's a great way to put it.
Yeah, it just measures the speed and magnitude of recent price drops. It tells us traders are panic selling, but an asset can stay oversold for a long time if the momentum is broken. It doesn't mean the bleeding is over.
So buying just because it's down 80% is anchoring bias. You're assuming it has to return there, completely ignoring the downside risks and the volatility.
Precisely. The market doesn't have a memory. Right now, SMR is testing an immediate support floor near the $11.55 day low, with major resistance sitting at $12.60.
That's a tight squeeze.
It is a danger zone. If it hovers between an $11.55 support and a $12.27 50-day SMA, any bad news breaks that floor.
Well, if the charts look like a potential retail trap, we really need to look at what the quote-unquote smart money and the people running the company are doing with their own shares.
Yeah, the insider activity.
Here's where it gets really interesting. We are seeing unprecedented selling. Historically, insiders have dumped over 72 million shares total.
It's wild.
And in just the past 90 days alone, 27.07 million shares were dumped, including, get this, a single director selling 13.5 million shares. One person.
Yeah, what's fascinating here is how clearly that signals institutional sentiment. Insiders sell stock for various mundane reasons, like maybe they need to buy a house or they have a massive tax bill.
Right.
But an insider does not dump 13.5 million shares in a 90-day window to buy a house.
Exactly. That isn't a tax strategy. That is an evacuation.
It absolutely is. It's a hugely negative signal. And you have to pair that insider flight with what the analysts are doing. Citigroup recently downgraded SMR to a sell, completely slashing their price target from $11.50 down to $9.
Which perfectly aligns with that technical floor you mentioned, potentially breaking.
Yeah.
But here is the glaring contradiction I don't get.
Okay.
Despite Citigroup's downgrade, and despite the company's own director dumping 13.5 million shares, the broader Wall Street consensus is curiously mixed.
Yeah.
Across the board, there are 6 buys, 8 holds, and 2 sells. And the average price target is $20.73. It ranges wildly from $8 to $52. And the average daily volume is heavy, like 41.2 million shares.
Great.
So if the average analyst target is nearly $21, but the people inside the house are running for the exits, shouldn't we do too?
It's a great point. What you have to remember is that average price targets are lagging indicators.
Okay.
When a stock falls this fast, analysts at major firms don't immediately drop their targets. They have to run new models, go through committee approvals. The average target of $21 is just an aggregate of old, overly optimistic models.
So it's a ghost number.
Essentially, yes. Citigroup's recent sell rating is likely the more accurate short-term barometer of institutional sentiment here.
Okay, so with insiders fleeing, but Wall Street targets still looking artificially high, we're left with a massive contradiction. We have to debate the core business case here to determine if this is fundamentally undervalued or a definitive value trap. Let's look at the best case recovery scenario versus the worst case continuation.
Let's do it.
What is the bull case keeping this $4 billion market cap afloat?
The bull case rests on one massive catalyst: artificial intelligence.
Of course.
AI data centers desperately need power. Hyperscalers are building these massive facilities, and they require constant, uninterrupted baseload power. Wind and solar can't always provide that.
Because the sun goes down and the wind stops.
Exactly. So SMRs are perfectly positioned. And NuScale's massive advantage is that they're the only U.S. company with a fully certified small modular reactor design from the Nuclear Regulatory Commission.
Wow, the only one.
The only one. That NRC certification is a huge moat. Add in the $1.3 billion in cash they have, giving them a long runway. And the bulls argue that if they secure a partnership to power an AI data center, the stock skyrockets.
Okay, I see the vision, but I have to play devil's advocate against the AI hype here.
Go for it.
We keep hearing about the $10 trillion nuclear renaissance, but how can you ride a multi-trillion-dollar wave if you're being sued for allegedly faking your partnerships?
Oof, yeah. The lawsuit.
Right. The bear case isn't just that top-line revenue actually fell 15% in 2025, or the massive insider lack of confidence. Crucially, there are ongoing securities class action lawsuits alleging misrepresentation of partners. If I'm a tech giant, I want a reliable partner, not someone tied up in federal court.
And that's exactly why you have to weigh the two sides objectively. The best case recovery scenario is that the lawsuits clear up, those AI partnerships actually materialize, and the $12.60 resistance breaks.
And the worst case.
The worst case continuation lower is that the cash burn accelerates, the legal troubles deepen, and they break that $11.55 support, sending the stock tumbling into single digits.
Well, having laid out the absolute best and worst case scenarios, we really need to map out the actual timeline for when we will know which reality is playing out. What are the short-term and long-term horizons here?
In the short term, the outlook is expected to remain under severe pressure due to those legal headwinds, the momentum weakness, and of course, the Citigroup downgrade.
Okay, but what about a medium-term catalyst?
That would be May 7, 2026, the Q1 earnings call. And then long term, from a broader perspective, the stock is ultimately a binary bet on the $10 trillion potential SMR market.
So what does this all mean? Like, put yourself in the listener's shoes. How should they approach that upcoming May 7th earnings call? What specific metrics should they be listening for?
You have to ignore the noise and the PR spin. Focus strictly on two things: project timelines and cash burn updates.
Right.
This raises an important question, right? Can the company transition from an R&D money pit to an actual commercial entity? If leadership cannot provide verifiable dates for when commercial revenue will offset that cash burn, the market's going to punish them.
Right, because a certified design is great, but eventually you have to build the reactors and sell the power.
Exactly.
All right, well, let's briefly recap this intense dichotomy we've uncovered. We have an NRC-certified pioneer with $1.3 billion in the bank, battling class action lawsuits, falling revenue, and massive insider dumping.
It's a lot to digest.
It really is. So if small modular reactors truly are the inevitable power source for the AI revolution, the question you have to answer for yourself is this: will NuScale be the company that powers the future? Or will they just be the cautionary tale that early investors got trapped in before the real winners emerged?
That is the ultimate question.
Well, thank you so much for joining me to break this all down. And to you listening, thank you for joining our deep dive. Remember to leave your thoughts and your own analysis down in the YouTube comments. We read all of them.
Yep. See you in the comments.
Catch you on the next deep dive.